Good morning, good afternoon, everybody. How are you? I think my voice will last about 12 and a half minutes, so Wes has always been concerned about how long I present, so I reckon I've got the perfect cure for this one. James is a good South African, so there'll be no mention of cricket, cheating or ball tampering, so I think we're fairly safe at the moment. It's a great pleasure to be here today. I thought we'd take a slightly different journey, pressing the green button, there we go. A slightly different journey, and that journey covers a lot more about the successful adoption of managed accounts or managed portfolios into equity businesses. And predominantly, we've come to you with a case study today relating to a client that we've worked with some time, Euro Securities. It's a great pleasure. The head of private wealth here, Chris Webster, has joined me today. So he's basically said, what have you been saying for the last 2 weeks around the country? And flew out from Perth. So Chris, hope nothing surprises you here, mate. So here we go. Look, the starting point of what I thought we'd talk about is the convergence that's taking place in the traditional advice market, and certainly some of that convergence being driven by the equity businesses. I wanted to do a deep dive on Euros. I think it's a fantastic case study of a business that is truly realising the benefit of convergence, but also the changes that are taking place in the broking industry and what we truly believe at Hub24 to be the future of managed accounts. I think the evolution, as Wes rightly said before, a lot of it's mainstream. We think the next level is certainly about us being custodians of client data as well as of assets. And that's a big shift because that's one of the really hard things for this industry to solve, which is how do your platforms, how do your managed account providers actually provide solutions whereby they're not holding the assets in custody. And it's been a long-term challenge, and we think that that's the new normal to be achieved. So, as Wes talked about before, there's a number of industry forces that are taking place, and the rise of some of the newer platforms or some of the non-institutionally owned platforms has been pretty clear. About 4% of the FUA is represented on a whole range of those platforms, including ourselves and your premiums and your net wealth, and they're certainly picking up a disproportionate share of assets of late in net flows. In fact, up around circa 40%. I think we'd be mad to think that was going to continue long term, but maybe what it is an indication of is the breadth of the solutions that are being covered. And I think the earlier comments about widening of highways and finding new pathways, I think they will also converge where the competition of the big and the small and the new and the old will just continue to heighten, which we think is a great thing because it will deliver better advisor and client outcomes. So we've certainly seen that. We're seeing the movement of advisors in the industry is very active. The role also in that market of groups like brokers who are moving away from traditional share broking activities into being mainstream wealth managers is something that has become net attractors of advisors. So that strong brand, and many of the brands that you recognise in the broker industry are well-known household brands. You've got your Morgans, your Ords, your Euros, your Pattersons, some big brands there that really have strong client relationships. So we see a change there, the willingness for advisors to shift. But the major trend that I'll be talking about here is this stockbrokers embracing managed portfolios. And how that works. And you'd think a business that has historically skipped the whole platform space, the whole wrap space, was something that was bailed out of. And in many ways, the solutions were very much an IRIS, IPS style solution, direct equity portfolios. They just bailed out of the whole structure. Well, it's interesting, some of the most interested and aggressive players in this market now are very much your traditional brokers that are adopting new ways to do things. And my message today is that, and especially with a group like Euros, who we're going to profile in a moment, is it's not an either or, it's a both and. And this concept of both and how do you find a clear balance between the introduction of a managed portfolio, a managed account solution, into what has been traditionally long-only equity businesses with HIN sponsorship, is a big change. Now, the businesses, you look at groups like Ords, you look at Euros and the like, they don't even mention broking these days. They are wealth managers. So a group like Ords, if I'll talk about them to start, with Euros, they're a diversified wealth management business Listed market cap circa 190. Hopefully that keeps going up. I'm not as familiar with your share prices as some of the other ones. Stockbroking, corporate finance, a really traditional business, but a great business. Some 10,000 client relationships, or 10,000 clients that they have. This is a well-known West Australian broker. And you'd say successful with 35 traditional advisors, around about 6 traditional advisors operating under the Entrust brand, which is a traditional advice business, and some 20 plus other advisors operating under the traditional Euros securities brand, which is what you'd probably see as your broker-advisor model. As a profile, running internal platforms, usually the normal back-office style broker platforms, some $1 billion or close to $1 billion on those platforms, and there's traditional businesses here, and advisors are running enormous amounts of money highly effectively in this way. But this real attraction to HIN sponsorship has been a major driver of why brokers have not adopted managed accounts in their main form. So we're seeing a change here where that perception is moving, and there's probably more of a willingness to engage as long as the benefits are there for the clients. And I really did enjoy one of the comments before, which was about finding the right price point, the right structure, and the right solution for the clients is constantly coming up. And in some cases, it is just far simpler for having a client on managed funds under custody, having a high net worth client under HIN sponsorship, but you may actually have another offer which relates to your mass affluent, which is entirely appropriate to be in a managed portfolio under custody. So there's this real change in what's going on. I'll jump into the crux of the details here. And when we first started to talk to Euros, pretty clear interest points, and they were grow our business, service our clients, optimise our back office. And I think that's consistent with so many advice practices. We use a broker example here, but any business that's had a strong equities bias, these are key challenges that have to be resolved throughout. So some of the things that we had a look at for Euros was very much in growing advice revenue. I mentioned getting an expanded footprint, was how do you deliver a new model to your existing advisors that took them away from effectively a transactional model. So you can imagine with a West Australian broking firm that the issue of equities in WA, and that being probably your stock in trade for research, could cause a few issues occasionally. So if you've got a big broking business that's dealing on research and equities, what happens when the tide goes out? What's the conversation? So this transformation of brokers around when their core research capability changes because of market conditions requires a change to a more annuity-based stream. It's not just a West Australian group. You could be a large East Coast broker looking at large industrials. Again, what is the challenge? What's the fallback position? So we're certainly seeing brokers move across to annuity streams, and those annuity streams are about full portfolio management services, and as Sam mentioned before, driving down cost structures. Some of the other things that were mentioned as a part of the solution, I'll just have a look at this. My eyes are terrible at the moment. Was the ability to actually take existing data that is held on the broking systems, reuse that data to repopulate client accounts and have a seamless transaction. So this issue, and one of the things I'll mention briefly here, is that the collation of existing client data. We own a business called Agility Solutions. Agility is one of the largest data collectors in the industry. They supply to most platforms. They supply to groups like Class Super, a whole range of those. The ability to capture Euros' back office data that was already held for those 10,000 clients, to make it so easy to move that client into a managed portfolio where it's pre-populated as far as an application, and the advisor experience to be totally seamless, was one trick. The really hard part is, what do you do with all the HIN data? What do you do with all the existing information to pull it back into a consolidated report? So one of the solutions, or one of the challenges, is how do you take not only cash data, other platform data, direct equity data, and also your managed portfolio data, and re-represent that as a single client view? That's the hard trick. And I guess my message today is, if you consider managed accounts or managed portfolios as just a bolt-on solution to what you're doing in your existing business, you're probably selling yourself short on where the market is actually going. So the ability to re-represent our data back to Euros's back-end systems, which they were quite happy to use, but also to represent their equities data and their cash data back to their clients in a consolidated view, is now the core solution. And we believe that's the new norm. And I don't think the industry is talking enough about that, because open architecture should actually make this a lot easier. To give you a feel of what that actually looks like in practice, it just gives you a little bit of a feel of some of the screenshots here. And this is coming off the back-end systems, whereby the ability for a client and an advisor to drill through and see that detailed information, and ultimately the tax information and the knitting together of that tax information for HIN holdings, for custody holdings, and then to get a consolidated CGT report is absolutely the standard we should all be aspiring for. Otherwise, the true business efficiencies that people seek just won't actually be achieved. So we think there's a new game. It's not just never-ending reduction in price in the market. It's not just about new structures out there. It's actually about consolidated reporting, which is probably what the whole purpose of the solution was about. I'll just move through here as a moment. The ability to provide clients with informed information about all of their assets, and to provide a single solution whereby they can plug and play their data from a variety of sources in conjunction with their advisors, has to be where the future is going. We're investing heavily in that. So the ability for you to effectively design your own platform is where we're heading. You've got equities, you've got managed portfolios, you've got existing accounts, you've got legacy businesses. The world doesn't exist whereby you don't have those legacy decisions. So we don't think any business can actually make a headway into all of those areas as they appropriately should be. So being truly open, understanding your own data and your own business, and the ability to plug and play that in for the client for their best interest in their knowledge, we think is absolutely critical. So I'll just close out. I'm conscious of time and running short on VoiceBox. Some of the key messages that came out of here is that convergence is well and truly with us at the moment. The rise of the broker, I think, is a fair statement to make. I haven't done a survey of brokers in the room here, but I'm sure there's a number that are here. The investment research process that brokers have in their IP is exceptionally valuable, and commoditising or productising that into managed portfolios is absolutely a key component to their success going forward. But also outsourcing the source of other IP like international managers and strategic asset allocation is also the main game. So recognising where you're good and buying in other solutions, I think, is a fabulous both-and solution. The full integration of the back office shouldn't just sit with brokers. It should be a demand made by every advisor practice. You should be able to see your client data. You should be able to see it in one place, and should be able to deliver it in a coherent manner to your clients when they want it, and they can then adjust it as well. We think that the rise of managed portfolios is absolutely critical to traditional advice businesses, but also broker businesses. And we're absolutely rapt to be on a journey with a group like Euros and Ords and many other groups that are taking that path forward. Thank you for your time today, and I will pass over to my learned colleague here, who will not be talking cricket, but will be talking all things managed portfolios. Thank you for your time.
Thanks, Greg, and good afternoon, everyone. It's wonderful to see so many familiar faces in the audience. I was trying to be witty, but I think Greg's taken all the way from me. Actually, to see an ex-colleague of mine from cricket in the audience too, so I think I'll have to chat to him at lunch. There's been a lot of momentum and real noise in the managed account industry over the last few years, and I think with this being the Advisor Rocha, I think it's important we don't lose sight of and actually go back to the mission and purpose for which managed accounts were actually set up for advisors to utilise as they advise their clients from a fiduciary perspective. In doing so, it's important that from advisors meeting their fiduciary obligations, that they actually have a managed account solution that achieves that mission and purpose. And that managed account solution needs to be focused on two things. Firstly, a best practice investment solution. And now that is irrespective of whether you as an advisor take on that asset manager sort of role of constructing, managing, implementing the portfolio for your clients, or whether that's externally constructed, professionally managed, and implemented on behalf of your clients. The second area is really a best practice reporting, accounting, administration, a platform solution, as Greg has sort of covered today. So what I want to be focusing on is not the platform side. Greg's covered that. I'm going to be focusing about the best practice investment solution and how you as an advisor operating in a fiduciary capacity with your clients can achieve three very, very important outcomes. Firstly, that you maximize the potential for your clients to get the return that they actually deserve and to which they're actually entitled to achieve their needs and goals. Secondly, that in creating the finished article, in essence, we don't mess it up and never have to say sorry to your clients. Thirdly, that you don't end up with what can at times be a huge white elephant in your business. You could have the best platform structure, a high quality investment structure, but if there's no adequate level of client engagement, support on the ground, working with clients, you could have no fun in it and ultimately your clients not achieving their goals. So I thought what I would do, see if this is working, fantastic. We've had a few IT issues in other states, so it's good to know that Sydney's on track. What I thought I'd do at the outset is really just touch on our Morningstar Evolution in the managed account space. Now, as I said earlier, there's been a lot of momentum in managed accounts, and probably one of the issues that we see on a regular basis is that managed accounts are often sold as this magical product. When in actual fact, all they are is an implementation vehicle, just like a managed fund is an implementation vehicle, to achieve clients' needs and goals. In fact, managed accounts have been around for such a long period of time. We started working with them as a firm back in the 90s and early 2000s globally. And our expertise as a firm has really been about what's inside that vehicle, not the vehicle itself. So I said that we were sort of early adopters in the sort of 1990s and early 2000s. It wasn't really till 2012 that we really took that to a whole new level, so to speak. And a number of financial advisory firms that strategically partner with Morningstar said to us that a client need, and as part of that client need, they were looking for a managed account solution that could be constructed and implemented on their client's behalf. And over a 5-year period, we worked with about sort of 5 or 6 platforms over that time, and sort of have had a great history now for sort of 5 years, and to the point where today we've got approximately 140 managed account solutions we run for clients, either in a sort of sub-advisory capacity or in a fully implemented capacity. Now, what those clients said to us back in 2012 as part of that client need was that while managed funds were the established vehicle at the time, was exactly what they wanted from a professional management perspective, what it didn't provide was the transparency, beneficial ownership, the ability to manage clients' tax affairs. Their clients wanted to feel like they weren't investing in an institution, they were actually investing for themselves. So those advisors who focus very much on strategic advice were looking for a vehicle that achieved those outcomes and they could still deliver their strategic advice. And as I said, we had a sort of a 5-year history over that time, and what we've seen over the last 5 years is that managed accounts are far better understood today than they were 5 years ago. In addition to that, you take from an investment perspective, there's now a proliferation of ETFs relative to back in 2012, and platform technology such as what Greg has touched on a little earlier has just gone to a whole new level. But there's still a lot of work for us to do as an industry. So what we wanted to do back in 2017, beginning of last year, was really just check in to say, is that client need, which was identified in 2012 when advisors came to us, is it still relevant today? And we're pleased to say that the Investment Trends Survey said that the number one reason that advisors are looking for managed account solutions is they're looking for a professionally managed solution. But what had occurred in this 5 years is that there has been an emerging trend take place, and that is really a theme of advisors looking to also construct, manage, and implement their own managed account solutions. And it is within these sort of 2 key themes that we as a firm have now sort of regrouped and want to focus on, continue to develop best practices on these themes. Now, a couple of weeks ago when Toby and I were chatting about today's presentation, I said to him, I'm pretty tired of every time I go to a managed account conference, someone puts up on the screen why I have a managed account. We've seen that for a couple of years, so please forgive me. There is a reason for this. I wanted to go back to actually, and forgive me for using a cliche also, what is the job to be done? What's the actual problem to be solved by a managed account? And as I said, managed funds going back to 2012 and didn't provide the transparency, beneficial ownership, the ability to manage tax, paper-based models, administratively inefficient, plus compliance was get difficult and not necessarily appropriate for small account balances. Now, everywhere on the screen where you see a cross, the purpose of a managed account was to, in essence, to turn that into a tick. However, there are 3 areas where results have been mixed across the industry over the last sort of 5 years. And it's these 3 areas that I want to be exploring with you today, the best practices as we see, particularly as you operate in a fiduciary capacity. So what are the options that you have in terms of the role that you can take when it comes to constructing investment solutions? Well, in essence, the 2 key options. Either, as I said earlier, you can take on that asset manager role to construct, manage, and implement a solution for your clients, or there's an externally constructed, professionally managed solution that you can implement on behalf of your clients. There are a few derivatives along the way between those 2 points, but in essence, those are the sort of 2 key starting points. Our focus as a firm has been on these 2 areas. We've helped clients construct and develop their own products and solutions for a few decades now, and we've also done the latter. If you want to absolutely nail it from a managed account solution perspective when it comes to investments, there are 3 key areas to focus on best practices. Firstly, portfolio management. Secondly, investment trading operations, and thirdly, client engagement. And in doing so, achieve the mission and purpose and get the clients the returns to which they're entitled. So let's look at those, sort of dig deeper into those best practices, so to speak. The first area, portfolio management. And again, irrespective of the nature of the role that you take with regards to your managed account solution, what you see on the screen goes back to 2012 as an approach that we needed to take as a firm when clients came to us with the need they needed to solve. And that approach is that to provide all the things that they required, we had to start off with direct securities. That is the preference number 1, because that is how you're able to get the direct ownership, transparency, ability to manage tax, high conviction portfolios. And if there were no direct securities that could solve that need, it was then ETFs. Because again, you could get the sort of beneficial ownership. Thirdly, it was managed funds. And again, with managed funds, it was a case of looking at sort of sectors that you couldn't necessarily get the right exposure you wanted. Examples, global bonds, alternatives, etc. I'm pleased to say back in 2017 in the Investment Trend Survey, what you see on the screen is still relevant today. That's what came up. But what advisors also said is that they actually also require international security exposures. So that's probably a trend that you'll see going more and more going forward. And I'm pleased to say a lot of the platforms have made huge advancements in that area. So if that's a portfolio management, sort of portfolio construction, shall I say, aspect of portfolio management best practice, what are the other key areas that you need to focus on from a best practice perspective? And whilst the slide you have on the screen at the moment is a presentation all to itself, what I'm going to try to do is pull out sort of 3 or 4 key themes. And the reason why this is relevant for your world, this is actually if you want to be a successful fund manager in the next sort of 5 years, these are the key themes that you need to focus on. But if you are taking on that role of constructing the portfolios, these are the themes that are now equally relevant to you. First one, client engagement. A little bit about that in a few minutes. Second one, technology. This isn't platform technology, this is investment technology. And we all know, every one of you in the room as advisors know the sort of drive of sort of robo-advice and artificial intelligence. Well, that just comes more to the fore when you're actually constructing a portfolio, because if one is constructing a diversified portfolio, why not could a computer do the same thing? I don't know. So anyone who's an investment manager needs to be differentiating themselves in this space. The third one is fees. And Greg sort of touched on aspects of that in his presentation. But for us, this is the absolute key one today. Potentially a low return environment, fees are going to only become even more important going forward, and the regulator is focusing so much time and energy on it. So with this focus of fees and suboptimal performance outcomes for clients, that leads us onto the second area of best practices that one needs to focus on when looking at managed account solutions. And again, this is irrespective of the role that you take to construct yours. Why is it that when you invest in a managed account solution that is a models, and there's a model manager, so to speak, why is it that your clients often get a different performance outcome to the model itself? This is not where your clients should have been in 40% equities or 60% equities. That's a portfolio construction decision. Why is it that if the model portfolio return was, say, 8%, they got a 6% return, whatever the number might be? And a great lens with which to look at this is investment trading and operations. Now, when looking at fees, there are sort of two types of fees. There's explicit fees, and the previous slide I focused on was really managed fees and RCRs. Non-explicit is the intangible fees. Implementation leakage is by far and away the biggest cost to any client when it comes to investing in any investment, but even more relevant for managed account solutions. So what I've got on the screen is really three key areas to focus on in terms of have the most impact on implementation leakage. The first and most material is a poor trading strategy. That is the number one reason. Second reason, and I'll touch on that in a second, what that sort of means. Second one is indirect costs, and that's taxes and various other things. Again, subject to a presentation itself. And the third one is customization. And this isn't customization at a managed account level, but rather clients saying to you as advisors, I don't want this security in my managed account solution, whatever it might be. They might work for Telstra and don't want Telstra in their portfolio. So if a poor trading strategy is the most significant and most material contributor to implementation leakage and have a huge impact on your clients getting to their goals, for you acting as a fiduciary, what are the things you need to be aware of? Firstly, if you again take on that asset manager role, constructing, managing and implementing your portfolios, what you see on the screen is the best practices that we see that firms should be implementing in doing that. Secondly, if you've got working with an external third-party provider to help you with that, well, there's a number of questions you should be asking them. And what you see on the screen is that. We as a firm over 5 years, this is the area we've invested the most heavily without any shadow of doubt as we've evolved in the managed account space, because we see it as such a huge issue that can happen in the industry. There are three areas. Firstly, best practice processes. Pre-trade, trade, post-trade. What processes do you have in place? Reconciliations in place? And again, I could stand here forever on this, and I know I'm the last thing between you and a lunch break, so I'm going to try to get to the point pretty quickly. Secondly, systems. We have a system called FMO, Fund Management Online, which in essence is our source of truth of the model outcome. We then have FactSet, an external system to us, which we use from a risk management perspective. And then thirdly, Morningstar Direct is our proprietary system that we utilize from a risk management and reporting perspective. Other areas to focus on for investment trading operations is make good. What happens when an execution on a platform goes to the wrong security, whatever? What sort of make good provisions are in place? These are the questions you should be asking and need to have in place. So if a trading strategy is so important, let's look at a case study where the processes that I've just alluded to, that we've sort of, an example which shows putting it into practice and can show the importance for you of actually focusing on price impacts and looking at portfolios. So back in November 2017, we needed to, in managing a client's, and this was a balanced risk profile, we needed to sell out approximately 500,000 securities at $5 a share, a 2.5 million parcel of shares as part of that sort of trade update in the managed account solution. Now, the goal and purpose of doing sort of trading the portfolio is to ensure that you have no market impact at all on pricing when you execute those transactions. So what did our pre-trade analysis show us? Well, it showed us that, which is often a surprise to advisors, is that even though it's an ASX 200 security, liquidity was an issue to trade 500,000 of shares meant that you could potentially move the market. In addition to that, we felt that this isn't our clients' wealth, it's your clients' wealth and their hard-earned savings. We didn't think it was worthwhile taking the risk to actually execute that transaction on platform. We worked very closely with the platforms to do a whole lot of pre-trade analysis to get the right outcome. From a trading perspective, and I'm not sure if the pointer can work, I think, there we are, it's working. What I thought I'd just explain on the slide, we decided to do it over an 8-day period, and what you can see in each day is the volume of securities that was traded in the market in that day in orange. Yellow was what Morningstar traded for our clients. Look at day 2. We could have got lucky and gone to market and it had sort of no impact on pricing, but it's not worth the risk. We're looking to target 20% of daily volume when we trade a managed account solution for our clients. That's the target. Each day it is a case of checking with the platforms, doing post-reconciliations, post-trade checks, and running it each day, the same process again. Again, the purpose, we don't want any market impact. That is the absolute goal over that 8-day period. So what's the last area of best practices as we see it when it comes to managed account solutions? So we had portfolio management, we've now had investment trading operations. Thirdly is client engagement. And this is where, in our view, where we've seen a number of managed account solutions in the industry and there's just not a lot of fun, or hasn't been a lot of take-up, this is the major reason. One's got to be very, very, very careful when you provide clients transparency. And the reason for that is that they might not have had it in the past. The next thing you know, that client potentially paying you an advice fee of, I don't know, $1,000, $2,000, and every time there's a trade update on the phone to you, finding out what's going on. So you've got to be very careful and make sure your business is ready for it and geared up to actually deal with the engagement if you are going to do it. And who do you actually make it available to? From our perspective, we think it's important that there are materials that are provided to advisors from a investment to advisor perspective, and then advisor to client perspective to get the right outcomes. And then thirdly, you'll see that is an area of behavioral science, and that's where we've invested heavily as a firm globally. We've got behavioral science boards and about 12 permanent employees focusing nothing else on behavioral finance techniques that advisors can utilize with their clients. And we see that as absolutely key to ensure that we don't end up with this potential outcome on the screen, which is there's the investment return. Implementation is the trading operations. You want to pull out lost performance there and then have the behavior gap, because clients are now getting that transparency and wanting to know, do I need to change my portfolios? What I need to do? Are you geared up for it? And the behavior gap is a critical thing to avoid, because research has shown the number one reason clients don't get to their goals is they actually pull out portfolios at the wrong time at the wrong reason. So it's important that you as a firm are geared up to deal with that. Advisor Gamma is a piece of research we've done globally where we've looked at the value of advice that advisors deliver to their clients, which is on average about 2.5%. So to actually, the art of maximizing investment performance for your clients is to make sure you're doing all those, and that's key to incorporate as part of your managed account solution. I'm not sure if there's any questions for Greg and myself as we sort of go through it.